39% headline distribution yield, paid every week, sounds like an income machine with the dial snapped off. But in this matchup, the fund advertising that 39% yield has delivered a simple distribution-inclusive return of negative 39% since launch. Its rival advertises 21%, pays monthly, and has produced a simple distribution-inclusive return of 33%. Same underlying company, two very different machines. And one of them is a vivid reminder that cash landing in your account is not automatically profit. Sometimes the fund is handing you pieces of your own investment, while the structure underneath gets smaller. Today, Income Autopsy is putting NFLP and NFLW on adjacent examination tables to find out what each fund actually owns, how each one turns Netflix exposure into distributions, and why the louder payout did not produce the stronger result. NFLP is the Curve Yield Premium Strategy Netflix ETF, issued by Curve and launched on October 27, 2023. It is an actively managed derivative income fund built to provide current income and capped gains tied to Netflix stock. The important phrase is capped gains because NFLP is not simply buying Netflix and forwarding the ride to you. Under the hood, NFLP is a synthetic covered call strategy. Instead of relying on a plain block of Netflix shares, it uses standardized exchange-traded options and customizable flex options to construct exposure around Netflix. Its listed holdings show United States Treasury bills at 119% and the Fidelity Investments Money Market Government Portfolio, ticker FIGS, at 4%, plus 3 call options and 1 put option used in the premium income strategy. Those cash-like holdings are the collateral pile. The options are the machinery. In plain English, NFLP parks substantial assets in short-term government instruments, then uses option contracts to create Netflix-linked behavior and collect premium. Selling calls brings in cash, but it also sells away some of the upside when Netflix surges beyond the option terms. The put helps shape the synthetic exposure. That is the bargain. Option premium can support a monthly distribution, while the shareholder accepts that a roaring Netflix rally may not flow through cleanly. The strategy can monetize volatility, but it cannot repeal market losses, and a distribution can include return of capital rather than pure economic profit. NFLW is the Roundhill NFLX Weekly Pay ETF, issued by Roundhill and launched on June 18, 2025. It is also actively managed and tied to Netflix, but it is not the same income recipe wearing a different label. NFLW seeks weekly distributions while delivering 1.2 times leveraged exposure to the weekly price return of Netflix. Its listed holdings show United States Treasury bills at 138%, a Netflix Inc. ComSwap NM position at 107%, and direct Netflix stock, ticker NFLX, at 13%. The swap is crucial. It is a contract designed to transmit Netflix's price movement without requiring the fund to own an equivalent amount of stock outright. Combined with the direct shares and Treasury collateral, it gives NFLW more than ordinary weekly exposure to Netflix's movement. That makes NFLW a leveraged trading vehicle with a frequent cash distribution schedule, not a conventional stock income fund. Netflix does not need to become a dividend stock for NFLW to pay weekly. The fund packages its leveraged strategy into distributions, but the payment frequency does not tell you whether those payments came from durable gains. If the strategy does not earn enough to cover what leaves the portfolio, the missing material comes out of the fund itself. Weekly leverage also means the path matters. Repeated reversals can damage a reset-style strategy even if Netflix eventually returns to a familiar price. So the clean distinction is this. NFLP sells option-defined upside in exchange for premium and monthly cash flow, with a large collateral base supporting a synthetic covered call structure. NFLW uses a swap, direct shares, and Treasury collateral to target leveraged weekly Netflix price exposure while paying every week. NFLP is trying to harvest volatility and accept a ceiling. NFLW is amplifying the short-term ride and coupling it to an aggressive distribution schedule. They orbit the same stock, but one rents out part of the roof while the other bolts a turbocharger to the elevator. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold NFLP, NFLW, Netflix, or any other security. ETFs can lose value, and high distribution rates can come with leverage, option risk, return of capital, declining net asset value, or other trade-offs that are not obvious from the headline. Verify the current prospectus, holdings, distribution notices, tax documents, and other official fund materials before making any decision, because strategies and figures can change. Consult a qualified financial, tax, or legal professional who understands your circumstances. Now to the marquee. NFLP reports a 21% headline distribution yield and pays monthly. NFLW reports 39% and pays weekly. Both rates are genuinely extreme, but a distribution yield is a description of cash flow relative to a reference value. It is not a certificate showing that the fund earned that amount without consuming capital. NFLW wins the billboard contest. Its stated rate is higher, and a weekly schedule creates a powerful feeling of momentum. Cash appears again and again, which can make the product seem productive before the investor has checked what happened to the value producing that cash. Frequency is convenience, not quality control. A paycheck arriving more often is wonderful when the business behind it is healthy. When the underlying pool is contracting, frequent payments can make the extraction easier to overlook. NFLP's 21% is lower than NFLW's 39%, but lower does not mean conservative. A rate at this level demands an explanation. Here, the intended engine is option premium generated around Netflix exposure. Volatility can make those contracts valuable, and selling away defined upside converts some of that volatility into current cash. Yet the premium is compensation for accepting limits and risks. It is not free income materializing beside the stock. The schedules also create different planning experiences. Monthly payments from NFLP may fit the rhythm many income investors expect, while NFLW's weekly payments may appeal to someone who values very frequent cash flow. But the proper comparison is not how often the account notification appears. It is whether the remaining investment and the accumulated distributions together leave the holder ahead. Expenses add another small but persistent drag. NFLP charges 0.99% and NFLW charges 1%. The gap is tiny. Neither fund earns a meaningful advantage from price alone. Both are specialized, actively managed products charging roughly the same rate for different forms of Netflix-linked engineering. The strategy outcome matters far more than that narrow fee difference, but the fee still has to be overcome before shareholders keep the benefit. Scale deserves attention too. NFLP has $4 million in assets under management, while NFLW has $6 million. Both are small funds. That does not prove either strategy will fail, but it means investors should verify current trading conditions, spreads, and fund documents rather than assuming the experience of a giant, deeply established ETF. The yield headline is the invitation. The economic source, fund scale, and value left behind are the background check. Net asset value is where the glossy brochure meets the balance sheet. NFLP began from a launch reference price of $25.55 and now has a latest NAV of $17.11. Its NAV return since inception is negative 33%. That is substantial damage. The monthly deposits did not preserve the quoted value of the share. NFLW's path is harsher. It began from a launch reference price of $50.40 and now has a latest NAV of $15.51. Its NAV return since inception is negative 69%. The fund has lost well over half of its starting NAV. Against NFLP's negative 33%, NFLW's negative 69% shows that the leveraged weekly structure and distribution burden have coincided with much deeper capital deterioration. Why does this dimension matter? Because future distributions are produced by what remains. If a fund starts with a full water tank and repeatedly sends cash through the faucet while the tank shrinks, the visible stream can look generous even as the system loses capacity. A falling NAV does not automatically prove fraud, failure, or a bad product. In a distribution-focused strategy, some decline can reflect cash deliberately moved from the portfolio to shareholders. But the size and persistence of the decline tell you how much of the original base is still working. NFLP's price path says the option income trade has exacted a real capital cost, yet it has retained far more of its launch value than NFLW. The result fits the nature of the structures. NFLP accepts capped gains to collect premium, so it may lag an explosive rise in Netflix while still receiving option income. NFLW targets leveraged weekly price movement, which exposes it to amplified adverse moves and path dependency. If Netflix whipsaws, leverage can turn the journey itself into a source of decay. The launch dates are different, so this is not a same-period horse race. NFLP has operated since October 27, 2023, while NFLW began on June 18, 2025. Market conditions and Netflix's path during those windows were not identical. That limits any claim that one structure would always beat the other. Still, each fund must be judged against its own starting point, and the observed record is unmistakable. NFLP's NAV fell sharply. NFLW's fell much more sharply. For an investor evaluating current documents, the key question is not whether a lower share price merely looks cheaper. It is whether the mechanism can support future exposure and distributions from the reduced asset base. A low NAV after heavy payouts is not a clearance sticker. It is evidence that the remaining engine is smaller. Now we put the cash back onto the table, because NAV alone is incomplete for funds designed to distribute. NFLP has paid $16.90 per share in cash distributions since launch. Adding those distributions to the change from its launch reference price produces a simple distribution-inclusive return of 33%. That is the central fact in NFLP's favor. Its share value fell, but the cash paid out more than offset that decline under this simple measure. An investor who looked only at the chart would miss a large part of the result. An investor who looked only at the 21% headline would also miss the capital damage. The fair reading requires both halves. The wrapper deteriorated, yet the combined outcome was positive. NFLW has paid $15.16 per share in cash distributions since launch. After including that cash with the change from its launch reference price, the simple distribution-inclusive return is negative 39%. Here, the payment softened the fall but did not repair it. The investor received meaningful cash and still ended with a large overall loss under the same simple framework. This is where the head-to-head stops being a beauty contest between 21% and 39%. NFLW offered the higher advertised rate and more frequent payments, but NFLP produced the stronger all-in result in the data provided. The difference is not cosmetic. NFLP's distributions transformed a negative price experience into a positive combined result. NFLW's distributions transformed a much worse price experience into a less severe, but still negative, combined result. The simple calculation has limits. It does not tell us what happened to every purchase made on different dates, whether distributions were reinvested, what taxes an individual paid, or what execution prices were available. It is a clean launch-to-latest comparison using the supplied reference prices and cumulative cash. That makes it useful for diagnosis, not a personalized account statement. Consider the two questions an income investor must separate. How much cash did the fund send out? And after accounting for the value change, what did the entire position accomplish? NFLW looks stronger on the first question only if the viewer is captivated by rate and frequency. NFLP is decisively stronger on the second question in this record. That is why total return is the antidote to distribution theater. It forces every dollar that arrived to stand beside every dollar of value that disappeared. Risk is not an abstract warning label here. NFLP's maximum drawdown was negative 61%. NFLW's was negative 73%. Both holders had to endure severe declines, and NFLW's trough was deeper. A fund can finish with a respectable distribution-inclusive result and still deliver a brutal ride along the way. NFLP demonstrates exactly that tension: positive destination, harrowing route. A drawdown measures the fall from a prior peak to a later low. It matters because real investors do not experience returns as a neat line between launch and today. They experience the moment when an account is far below its earlier high and must decide whether the strategy is behaving as designed or coming apart. At negative 61%, NFLP demanded extraordinary tolerance. At negative 73%, NFLW demanded even more, while ultimately failing to restore the holder on an all-in basis in the supplied record. The distribution trend adds another layer. NFLP's first 4 distributions averaged 41 cents per share, while its latest 4 averaged 30 cents. The recent average is 73% of the early average. The payout has declined, but it has retained most of that initial level. That does not make it stable in the ordinary bond-like sense. It does show a materially better level of retention than its opponent. NFLW's first 4 distributions averaged 50 cents per share, while its latest 4 averaged 12 cents. The recent average is 23% of the early average. That is not a gentle adjustment. The weekly payment is still frequent, but the amount represented by the latest average is far smaller than at the start. This is the trap hidden by annualized-looking headline rates. A yield can remain visually dramatic when a share's value has collapsed because the rate is being compared with a much smaller base. Meanwhile, the dollars and cents reaching the holder may be falling. NFLW combines the deeper drawdown with much weaker distribution retention. NFLP also shows payout deterioration and major drawdown risk, but the damage is less extreme on both measures. The strategies expose shareholders to different failure modes. NFLP can underperform when sold calls cap participation in a strong Netflix advance. Option positioning can also fail to provide enough premium to offset adverse movement. NFLW's leverage can magnify unfavorable weekly moves, while reversals can punish a strategy that targets leveraged exposure over short intervals. Neither is a set-it-and-ignore-it substitute for cash or a conventional dividend portfolio. There are also product-level risks that deserve monitoring because both funds are small and specialized. Holdings can change, swaps introduce contract exposure, options can behave sharply around volatility, and distribution policies can change. The correct habit is to check current official materials, not assume the machine still has the exact configuration described at launch. In this autopsy, NFLP is the patient with scars and a pulse. NFLW is the patient whose capital base and payout strength both deteriorated far more severely. NFLP's assigned verdict is stable with a condition. The condition is not fine print, it is the entire bargain. Its simple distribution-inclusive return is plus 33% even though NAV alone is negative 33%, and its latest 4 distribution average is 73% of its first 4 average. The fund did what an income strategy is supposed to prove it can do. Move cash to the holder, and under the supplied simple measure, leave the combined result positive. But it did so with capped upside, a deeply damaged NAV path, and a severe drawdown. Stable here means the strategy has produced a defensible all-in outcome, not that the ride was calm or the principle stayed intact. NFLW's assigned verdict is cause of death, NAV erosion. Its simple distribution-inclusive return is negative 39%, NAV alone is negative 69%, and its latest 4 distribution average is only 23% of its first 4 average. The cash was real, but it was not enough. The capital base collapsed faster than the distributions could compensate, and the payout level itself weakened dramatically. The advertised rate cannot overrule that evidence. The decisive head-to-head conclusion is that these are different tools built around the same volatile company. NFLP is an option premium tool for someone researching a willingness to exchange part of Netflix's upside for monthly cash, while accepting substantial NAV and drawdown risk. NFLW is a leveraged weekly exposure tool paired with weekly distributions, demanding an understanding of path dependency, amplified losses, and the possibility that frequent cash masks rapid capital decay. Which tool fits depends on the goal, the risk tolerance, the tax situation, the holding period, and the investor's view of Netflix's path. This comparison does not tell anyone to buy, sell, or hold either fund. It tells you what to inspect: the machinery, the value left behind, the all-in result, the worst decline, and whether the payout is holding up in dollars and cents. On the evidence provided, NFLP has earned cautious credit with a serious condition attached. NFLW's louder promise has been overwhelmed by NAV erosion. Keep the diagnosis research only, verify the current fund documents, and never confuse a distribution with a cure. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these 2 would you pick and what matchup should we run next? We read everyone. Thanks for watching.